Welcome to Founder Files, the podcast for growth-minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI-powered and human-led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. Welcome back to Founder Files. Today's episode is about something most founders think they have, but very few actually do. Strategic financial visibility. We talk a lot about finance as a growth factor, but numbers alone don't create value. They're important, you need to have them, they need to be accurate. But alone, they don't create that much value for your company. What actually creates value is insight and real decision-driving clarity. And to have this conversation properly, I wanted someone who sits at the intersection of strategy, data, and enterprise value creation. Today's guest is Nick Jain, a growth architect and EBITDA multiplier with a track record of transforming companies into best-in-class assets. With experience at McKinsey, Bain Capital, and a Harvard MBA, he combines analytical rigor with operator intensity. He has led turnarounds across SaaS, logistics, and e-commerce businesses. One example that stands out as CEO of IdeaScale, a B2B SaaS company, he moved EBITDA from 10% to 35% in just 18 months. Reignited growth from flat to 10% and led the company to win a Gartner Award in its category. He doesn't just analyze businesses, he transforms them. So today we're talking about the intersection of strategic finance and business intelligence and how founders move from reporting numbers to multiplying value. Let's dive in. So I'll turn to Nick and say welcome. Thank you so much for being here today.
Thank you for having me and for the wonderful introduction.
Awesome. It was well deserved. Did I miss anything, by the way, Nick, in the introduction?
That was awesome. Thank you so much.
Awesome. So I want to break this episode into two parts. The part one is strategic finance and the rise of the practical CFO. This is especially something that I really wanted to discuss with you because not only are you very focused on strategy, but you also complement what CFOs do on a day-to-day. So to get started, let's talk about what strategic finance actually means, especially for founders between $1 million to $30 million in revenue. And how is it different from accounting or ongoing fp&a management?
Got it. So look, almost all of finance rolls up to a CFO, right? And there's typically three legs of it. There's the accounting side or the accounting or controller. There's the treasury side, like who's actually paying the bills or, are your customers paying you? And then there's the fp&a side. Accounting is typically about recording what happened, and that's really important, whether you call them a bookkeeper or an accountant, because if you don't know what happened, you don't know where you're going. The treasury side is important because, you have to pay your bills, and conversely, your customers have to pay you. It's important to keep, some governance on cash going out and cash going in. And then the fp&a side is, okay, what does this all mean? What are the right decisions we should make? If somebody wants to open a new warehouse, it's not just, hey, it costs us $100,000. Are we going to make $1 million off of spending $100,000? It's about all that return on investment decision-making that you have to make for even the small decisions from pricing up to the big decisions like, are we opening $1 billion data center? And what strategic a CFO does, he or she controls all those three divisions of finance, but also spends most of his or her time on that fp&a side thinking about, hey, how do we make that business better tomorrow?
So, there are some CEOs or founders who may have a finance team, but that's more focused on executing an fp&a, but not so much driving that decision-making and getting the insights from the fp&a. What are some warning signs that a company may be stuck in transactional mode and not necessarily getting the data and information that they need from those transactions that they're working on a daily basis?
That's a hard one. I'll give, I think, two. I'll attempt to give two signs. Number one is if you're constantly being caught by surprise, that's telltale sign number one that someone's not thinking about the future. Because, yes, there's surprises that come up in life and running businesses. But if every day is a surprise, then someone is not looking at the future.
Yeah.
And number two is if no one's thought about the range of possibilities, what could happen next year, next week, not just what's your 5-year plan or your 1-year plan that you're presenting to your board, but what are the different states the world could be in or that your business could be in.
Yeah. Different scenarios.
Yeah. Exactly. And somebody, usually it's not somebody's job to think about scenarios, and it should be someone's job. And
Yeah.
at well-run companies, it is someone's job.
Yeah. And add to that, if you have a finance team that's doing all the work, you say, okay, great, I do have a forecast, I do have my KPIs, I do have my dashboards, but you still don't make decisions off of those. That's when you should probably be asking yourself those questions of, do I have the right team that actually supports me and gives me the information I need to make the right decisions
Dashboards and KPIs look great, but if you're not doing anything with them, you just
with
waste a
them?
bunch of time. The hope, though, they're means to an end, but the end ultimately is better decision making.
And obviously, there are different stages of growth. At what point do you think a founder really needs that CFO level support, whether it's fractional or in house? But let's talk more about fractional because our audience is probably, looking for fractional support. They may not be ready for a full time hire.
So I think the point at which your business is not just in blocking and tackling. So when a business is very, very new, they only really have one focus, like gets revenue and get customers, okay? And that is 100% the focus of the founders of the small team that exists. The moment that it is beyond that, the moment that you're thinking about other things like expanding to new markets, launching products, pricing, the moment you are not just thinking about what you need to do today to be able to feed yourself, your business, your family, the moment you start thinking about tomorrow, you want to hire some sort of FP&A resource, whether that be an FP&A analyst, a fractional CFO, a full-time CFO. The moment you have to start worrying about tomorrow and not just for today.
Yeah, or there's additional complexity in your business where it starts to get overwhelming and dark. You're not really seeing where you're going, which could happen very quickly, especially in high growth businesses. We now hear a lot of the word practical CFO. What do they actually do? I know we touched on that and it may make sense, but let's just recap that real quick.
Sure. So I think there's been an evolution of what the term CFO means. I think in 100 years ago, it was really like your senior accounting person and treasurer focusing on those first two elements, the treasury and the accounting side. And I think that's really what most people, small business owners think of CFOs to be today. Hey, they're handling my money side, they're doing the accounting. However, in larger businesses, and especially amongst professional CFOs, the role has evolved into a practical or strategic role where he or she is not just recording what happened to the money in the past and dealing with bank accounts in the present, but it's helping you, the CEO or the COO or the other C-level executives, think about, okay, what is the right ROI positive business decision? Are we investing in this marketing channel? Should we spend more time on Facebook ads or Google ads? Or should we open a new warehouse? Those sorts of decisions are increasingly in the province of good CFOs who are making, as you said, practical business decisions, not just doing the accounting and treasury side of things.
Yeah, I agree. What do you think of CEOs understanding finance and having CFOs that actually teach them finance and not just give them the insight?
Sure. So I think a good CEO in any line of business should have a little bit of understanding of really every part of their business, right? Like if you're running a software company and your CEO doesn't necessarily need to know how to code, but he or she should be able to pull up a coding terminal and write a few lines of code. And the same is true with finance, right? Like your CEO does need to understand, FINRA or FASB rule number 670B, right, on the accounting side.
Yeah.
Doesn't necessarily need to know the compliance for money movement in Japan or how to run a Monte Carlo capital allocation model, right? But he or she should know what all those terms are, and a good CFO should at least, make sure that their CEO understands these, because otherwise you're not on a partner, right? Like a good C-level executive in any domain, whether it be marketing or finance, should be a partner to the CEO, not just like a guy or gal doing some random work.
I totally agree with that. That's also my motto, as we say. If there are founders out there or CEOs who are looking to add a CFO to their team, what do you think they should pay for that? Or maybe if that's too specific of a question, how much do you think a founder or CEO, how much should they invest into their accounting and finance function?
Sure. So I want to separate the accounting function from the kind of the CFO or the FP&A function. So accounting really depends on the complexity of your business. If you have 5 customers and they're simple one invoice a month, you can probably pay like a few $100s or a few $1,000s for the accounting and ATAR function because you're doing 5 transactions a month. If, however, you're doing 1 million transactions that are all $1 a piece and all need to be reconciled, your accounting function might be a little bit more expensive. On the CFO or FP&A side, those people tend to be quite expensive. So full-time good CFO, not just a controller who has the title of CFO, but someone who's got that strong analytical background, maybe spent some time in investment banking or management consulting. They're minimally going to cost you somewhere between $250,000 to $500,000 a year on a fully loaded basis, even if you're running a $5 million business. Now that sounds expensive, right? Why are you paying somebody $500,000 when you're a $5 million business? Chances are, they're probably going to save you more than their salary right away. But yeah, like don't if you're going to hire a real CFO and not just a controller or someone to do the accounting side, which again is important, you want to do those. Those are table stakes for your business. Don't be cheap on your CFO. They are a resource that will pay themselves back pretty quickly.
Is there a benchmark or a percentage of revenue that you think of that's a rule of thumb, or not really?
For an SMB, I think. No, I don't think a percentage of revenue. I think like a good CFO is going to cost you somewhere between $250,000 to $500,000. And that's going to be a fixed cost, whether you're running a $5 million business or a $30 million business. I don't want to give a percentage of revenue because when you're running Goldman Sachs, it doesn't make sense to quote your CFO as a percentage of revenue because Goldman Sachs, I'm making up the number, does, $100 billion of revenue. Your CFO is not making 1% of that, right? $1 billion a year.
Yeah, yeah. And you're referring to full-time CFOs, right? Because they still have the option of fractional, in which case they can go for a much cheaper route and still have that support.
Yes, a fractional CFO, again, focusing on the strategic or practical CFO, not just someone kind of supervising the accounting side.
Yeah.
Is probably going to a good one is probably going to cost somewhere between $10,000 to $20,000 a month for fractional, again, analytically oriented CFO. So that's what, let's say $15,000 a month times 12 months. That's $180,000 a year. So you're not paying the full $250,000 to $500,000 full-time price that I mentioned, but it's still reasonably expensive. Again, assuming you're going for a quality person who is analytically inclined and not primarily a controller or treasurer. Those obviously be significantly cheaper, but it's a different skill set.
Sounds great. Thank you for that.